Right, no fluff, straight in. Morgan, my man, Mr. TradFi, you're looking at charts all day. We're talking implied volatility. To a crypto degen like me,
Yeah.
it just sounds like a fancy way of saying things are about to get mental. Break it down for the people. What is it really?
Mate, you're not wrong. Think of it like this. It's the market's pregame jitters priced in. It's a forward-looking guess on how choppy a stock or an asset is going to be.
Right.
Is it going to be a calm, boring Sunday drive or a full-on rally stage with jumps and slides? That's IV. High IV, big moves expected. Low IV, everyone's snoozing.
So it's basically the VIX, the fear gauge.
Exactly.
Like for any single stock or Bitcoin.
Exactly. The crucial bit, and this is where people get rinsed, is that IV tells you about the size of the expected earthquake. IV tells you about the size of the expected earthquake, not which way the building's going to fall. It's pure magnitude, zero direction.
Ah, okay. That's a key distinction because in crypto, we just assume the direction is up.
Right.
But the magnitude is the question. So how is it implied? Is it some backroom deal? Who's implying it?
Nah, it's not that gangster. It's implied from the options price. An options premium has a few ingredients: the stock price, the strike price, time, and interest rates.
Okay.
But the secret sauce, the thing that makes it all add up to the current market price, is the implied volatility. It's the number the market has decided on to make the maths work.
Got it. So traders aren't just betting on where a stock is going.
No.
They're making a bet on how wild the ride will be. That's a whole other dimension.
That is the dimension where the pros live, Chris. Your edge comes from having a better opinion on volatility than the rest of the market. If you look at the IV and think, nah, you lot are panicking, it's not going to be that crazy.
Yeah.
You sell options. You sell the fear. If you think y'all are way too calm, something's brewing, you buy options. You buy the calm before the storm.
Let's get practical. The classic noob trap is earnings season. Say Tesla's reporting. Everyone and their dog is shouting it's going to the moon or crashing to zero.
Right.
They rush to buy call options.
And they get absolutely fleeced. They pay a massive premium because the IV is sky high. Everyone knows a big move is coming, so the price of the bet is extortionate. Then the earnings land. The stock might even go up, but it doesn't move enough to cover that insane premium.
Wow.
The uncertainty vanishes overnight. IV plummets and the option's value gets obliterated. That, my friend, is the infamous IV crush.
We get that just before big crypto events. Bitcoin ETF approval, the IV on BTC options went absolutely parabolic. The news hits and whomp, instant haircut on your premium.
Yeah.
Even if you were right on direction, it's brutal. So how do you avoid getting played? How do you even know if IV is high?
You need context. That's where IV rank and IV percentile come in. They're dead simple. They just rank the current IV against its own history for the past year.
Okay.
If IV rank is 95%, it means volatility is higher now than it has been for 95% of the last year. It's objectively expensive. If it's 5%, it's cheap. It stops you from buying into the hype.
Okay, so it's a personal best for fear. I like that. But here's something that messes with my head. I look at an options chain and the IV is all over the place. A put down here has a different IV to a call up there. Why isn't it one number? The stock's the same, isn't it?
Ah, you've stumbled into the dark arts, my friend. Welcome to the volatility skew, or as I like to call it, the volatility smirk.
The smirk. I am listening. That sounds like my kind of vibe.
It is, because it's cheeky. It's the market literally smirking at you. In stock markets, out-of-the-money puts, the options that pay out in a crash, almost always have a higher IV than out-of-the-money calls.
Why?
Because fund managers and big players are terrified of a market crash. They constantly buy puts as portfolio insurance. That high demand pushes up the IV for those downside strikes.
So it's a visual map of institutional fear.
Yep.
And you know where we got even smarter signals than that? You're probably thinking complex option strategies, but honestly, it's in our private group that we discuss these in natural and deep conversations. The link is down below for no cost to entry, and it's for you many other ways.
You can see it, you can measure it, and you can trade against it. Now, let me flip it on you. Is it the same in crypto? Is the smirk the same?
Mate, in crypto, the emotion isn't fear, it's FOMO, fear of missing out. So a lot of the time, especially with Bitcoin, the skew is flipped. The calls way up high, the moon mission bets, have a higher IV. The greed for a 2x pump is stronger than the fear of a 50% dump. We call it a positive or forward skew. The market is smiling, not smirking.
And that's fascinating. It shows the personality of the asset class. Stocks are owned by pension funds that want to protect capital.
Right.
Stocks are owned by pension funds that want to protect capital.
Right.
Crypto is owned by degens who want a Lambo. The skew tells you the soul of the market. It's not what people are tweeting, it's where they're placing their real money bets on hope versus fear.
So tying this together for a trader, you use IV to gauge the expected chaos. You use IV rank to see if the chaos premium is cheap or expensive. And you use the skew to read the market's deepest, darkest bias. What's the main tool to manage this? One of your Greek letters, I assume?
You know it. It's Vega. V for volatility. Vega tells you how much your options price moves for every 1% change in IV.
Right.
When you buy an option, you are long Vega. You want IV to explode. When you sell an option, you're short Vega. You want IV to die a quiet death. A rookie buying calls before earnings gets destroyed by theta, time decay, and Vega, IV crush.
The rookie's graveyard. That's why the pros are selling the options, acting as the casino, collecting the premium from the hopeful. This is top tier stuff. Listen up, everyone. We're diving deep like this all the time in our private group. The link is down below. Hop in and have a laugh with us. It's free, unlike the premiums on a high IV stock.
Well said. So the takeaway is this. Implied volatility is the price of uncertainty.
Yeah.
Your entire job as an options trader is to look at that price and decide, is the market's fear justified or are they all just being dramatic?
Spot on. All right, let's leave the listeners with a proper brain melter.
Go on then.
Now, here's a question we'd like you to think about. If you had to build a trading strategy for the next 6 months and could only use one of these two signals as your primary trigger, the IV skew showing extreme fear, or a price chart showing a classic bullish breakout, which one would you trust more and why? What does your choice say about you as a trader?